Okay, good day everyone. This is DBS Group Holdings third quarter 2024 financial results dated 7 November 2024. Right, day of recording of this video is 25th December 2024. So Merry Christmas to all my listeners. Right, on 7 November 2024 on the time which is the date the result was released, there was this spike in the price. So let's try and see why the market reacted so positively to these results. Right, so here they discuss dividends continue to be the primary means of capital distribution, and here they talk about the fact that ordinary dividends have doubled since 2019. Right, so in 5 years they have managed to double the actual amount of money they give out as dividends from $3.1 billion to $6.1 billion. Right, and this is a reflection of the structural improvements of the franchise as discussed in the annual report 2023. Right, you can look back 2 or 3 videos where I discussed it. Right, basically it's due to the structural changes they made in their in the bank itself, but it also partly is due to the high interest rate environment which has supported their net interest margins. Right, dividend yield is at 5.5%, but that's off this price here, probably around $39. Right, buyback program of $3 billion was announced, which is I think is the major announcement in this program. Right, if we look at later on, you'll see that this $6.1 billion based off 2024's distribution, right, is about 50% of their payout ratio. So with this $3 billion buyback program, right, if they actually use all the $3 billion, that means the usage of their profits is already 75%. Right, so we're getting quite close to them almost distributing all their money. Right, so they have about approximately $3 billion left over to keep. Right, so let's look at third quarter results. So right, third quarter net profit is up 15% year on year to cross $3 billion. Right, you can see record numbers for total income, profit before allowance, and net profit. Right, I did a comparison for first quarter and third quarter results for net profit here. You can see first quarter year-on-year performance is up 15% in this year. Second quarter is a bit disappointing, 4%. Third quarter is back up to 15%. Right, so the very good results from first quarter seems to be replicated in this quarter. Right, if we just look at consumer book side, which these 3 things: net interest income, fee income, and treasury customer sales and other income. Right, first quarter was up 14%, second quarter was up 9%, third quarter was up 3%. Right, so how come the third quarter net profit is so good? Right, it's probably more carried by this market trading income. Right, so it's the highest in 10 quarters. Right, but also this part did contribute as well. Okay, so we'll just have a quick run through. Commercial book net interest income rose 3% from balance sheet growth and stable NIM. Right, record fee income led by wealth management. Again, wealth management is a very big story this year. Right, treasury customer sales are also higher. Market trading income highest in 10 quarters. Expenses up 10%. Taiwan accounts for 3 percentage points. Right, quarter on quarter won't talk too much. Right, basically it's a good result. Right, net profit 9 months is 11% up to new high, which is expected because almost all the quarters are like all-time highs. Right, so total income, profit before allowance, and net profits again all-time highs. Not going to talk so much. If we look at commercial book net interest margin, is stable at 2.83. Group net interest margin has dropped slightly to 2.11. Loans are up 1% quarter on quarter, 2% over 9 months. Right, so this is good. Right, so they're still getting more people to borrow money. Deposits up 2% quarter on quarter. That's great. Yeah, fee income rising. Right, this one we discussed more in the last 2 quarter results. We were saying that in 2023 you realize that wealth management has never crossed the 400 million mark. It was always from $300 to $400 million per quarter. But when it comes to 2024, the first 2 quarters of 2024 is from $500 to $600 million, and now in this third quarter 2024 he has gone up to above $600 million. Right, so this is a very impressive aspect of their business, right, that has shown a lot of growth this year. Right, but note that wealth management is actually tied to market performance. Right, so if the market tanks, this side of their fee income may be affected. Right, so commercial book non-interest income is up 21% year on year. Record third quarter and 9-month wealth management income from AUM inflows and conversion to investments. Later you'll see that when they convert to investments, actually they make more money from fee income from wealth management, right? So that's a good thing for the bank, right? Cost to income ratio is more or less where they want it to be, 39%. Non-performing assets declined 8% quarter on quarter, contributed by repayment of recent cases. That's a good thing, right? A specific provision stable, right? Allowance coverage rises to 135%, right? This one, their CET and leverage ratios, is basically strong, no need to worry about it, right? Third quarter dividends is standard, it was expected it will be 54 cents, right? Right, so to summarize the results before we go into the CEO's comments, right? So another record performance in third quarter and 9 months. Commercial book net interest margin is supported by reduced interest rate sensitivity, while wealth management drove fee income to new high. New buyback program, right? Later we'll talk more about this. Well positioned to deliver healthy shareholder returns, right? That's music to the ears of all of us that are shareholders, right? So yeah, I don't think I'll talk too much about this because we've sort of discussed it. I think I'll go straight to I'll just give you the outlook for 2025, right? Group net interest income around 2024 levels, so they expect it to be roughly the same. A slight decline in group NIM, mostly offset by loan growth, right? Markets trading to benefit from lower funding costs, right? So that means to say, because it's cheaper to borrow money if the interest rates go down, they expect people to trade the markets more, right? Commercial book non-interest income growth to be high single digit, okay, led by strong growth in wealth management fees and treasury customer sales. Cost to income ratio expected to be the low 40% range, right? Specific provisions assumed to normalize at 15 to 20 basis points, right? This one I think they say later that it is they are being conservative when they estimate this number, right? Pre-tax profit to be around 2024 levels, however, net profit to be below 2024 levels due to global minimum tax of 15%, right? So yeah, let's go straight to what Gupta says, right? So they say that here the commercial book NIM will start declining slowly, right? Because interest rates will come down, right? But on the other hand, the NIM drag in the trading portfolio will reverse as well, right? The decline in group NIM this quarter by 3 basis points to 2.11 was due to this accounting asymmetry, right? I'm not going to pretend I actually understand what this is, right? But it doesn't sound like something too serious lah. It's either that it's a, yeah, the way I read it, it does appear to be a very serious issue with the bank, and they don't seem to be very worried about it. So I'm not going to be too concerned, right? Fee income is at a record high, and big driver is wealth management. The inflows have been diversified across North Asia, Southeast Asia, Middle East, and Europe, with clients continuing to put more money at work, right? So percentage of investments of total AUM rose to 56%. Right, so this percentage is higher is better because they get higher fee income, right? So we move on to trading, right? They say fantastic, highest in 10 quarters, 330 million this quarter. All right, so they talk about the non-performing assets, right? Both in China, one of them they need to write off. The other one is they're just being prudent, right? They are likely to recover the loan, basically they say, right? So it's only one that is written off, right? So they say they are seeing strong repayments and recoveries from 3 categories: oil and gas, money laundering, and the third one being the property cases in Hong Kong and China. All right, for Hong Kong and China, I think they say they are able to sell refinance assets and be able to reverse the non-performing loan within a year, right? So it's because their LTV is generally low. That means to say your asset worth $100, I only let you loan $50, right? So even if your asset is fire sale, right, I should be able to get the $50 back. Right, so buyback program, I think this is the part that people want to know about. Okay, they do not have a specific time frame for completing it. It might take a couple of years to execute because we're going to wait for the right opportunities. Right, I'm sure there are questions on whether, given our share price so high, it's a good time to do buybacks. Right, so he's admitting that actually the price of stock currently is quite expensive. Right, it's almost 2 times book value. Right, so here he explained that if you have strong belief in the fundamentals of the business, anytime is a good time to buy back. Right, because companies like JP Morgan and Apple continue to do buybacks even at high valuations. Nevertheless, they say they will be thoughtful about the time to exercise the buyback. So it appears that their buyback isn't constrained by the year, right? So they can say a couple of years, they can do it over a couple of years. Right. Actually, the purpose of the buyback is to try to return capital to shareholders, right? So they can do it via dividends, which they are paying out 50% of their net profits out as dividends already. That's the $6.1 billion we talked about earlier. So they are trying to return another $3 billion more to shareholders through buybacks, right? So why not give it out as dividends? Okay, I believe that there are a couple of reasons for this, right? So it's because if you give everything out as dividends, like, so you raise the dividends by 50% actually, right? Because the dividends they're giving out 6.1 billion and they want to give out 3 more billion, right? So if they raise their dividends to 75% or payout ratio, right, the problem comes when if we go through a prolonged crisis situation, right, where their earnings drop to below 75% of what they're currently earning, then their payout ratio will exceed 100%, which I think is not very healthy and not very prudent for a bank, right? So given that, right, it's better for them to use this buyback scheme to return money to shareholders, because they have the option to execute if they feel like, for example, next year's results are going to be good. Maybe they can execute the buyback slowly, and this is a long-term positive thing, because when you buy back the shares, right, basically everybody's pie of the company is bigger, right? So that gives them a leeway. And let's say if we go through a recession, right, the price drops significantly, even better, right? They can use the same $3 billion to buy back more shares, which presents more value for the shareholders. Okay, so it gives them optionality lah. And in the event that there's a recession and their earnings fall below 75%, they don't have to cut dividends, right? The problem with dividends is that once you start giving out, it's very hard to cut, right? So that being said, later on you'll see that actually they still are thinking about rising dividends, right? Anyway, let's move on to about the here they're talking about US elections, right? So here, this is what their assumptions are for next year. Their assumptions are based off a reduction of 2 percentage points by the end of next year. We assume 1 percentage point this year, right, of which 50 basis points already be done, and 4 more cuts next year, right? The market is now pricing in fewer cuts, which means net interest income might be slightly better than guided, right? So actually this year what they projected is more or less come true already lah. So the interest rates originally was something like 5.25 to 5%. It has now gone down at 18 December. This info is as of 18 December. Right, it has now gone down to 4.25 to 4.5%, which means interest rates this year has already dropped from the peak by 1%. Right, so their projection for this year is correct. Next year, however, if you look at what the Fed say, right, they say that here you'll only probably lower it twice more in 2025. Right, so if you lower it twice and each time it's 25 basis points cut, that means instead of a 1% drop in interest rate, right, it's actually a 0.5% drop in interest rate, which is better for the bank, because they can then make more money from charging people a higher interest rate for money, right? So this is a positive thing. So this is their base case is 8 rate cuts, but if this projection is correct, it's likely to be 6 rate cuts, right, according to how they count the rate cut, right? But it's possible, of course, you get 7 or even 8, right? But in the case of 6 or 7 rate cuts, then they will have a slightly better than expected situation. Of course, recession may be more than 8 rate cuts, right? So it's not necessarily true that 8 is the worst case, right? So anyway, so yeah, even if 8 rate cuts, they think they might be able to hold net interest income, right? Right, so they expect that group NIM will probably trend down a few basis points. Commercial book NIM will also be down, but offset by market trading NIM, which will benefit from lower funding costs, right, which they talked about earlier. Non-interest income is expected to grow high single digits, powered by wealth management. Right, our cost to income ratio low 40%, which is fine. Right, so here they talk about the specific provisions. They said that the 17 to 20 basis points is actually just being prudent. Right, so they're not expecting it to be so high. Yeah, so this one we talked about, right? There could be upside if the interest rate cuts are less than expected. We talked about that as well. But net profit is slightly lower than this year because of the tax global minimum tax rate being 15%. Right. I think we talked about this. Yeah. So here again they talked about the fact that they are trying to return money to shareholders. All three tools, ordinary dividends step up, right? So the fact that he said step up suggests to me that they are still considering raising dividends, which is a good thing for shareholders, right? Special dividends as well as buybacks. Of course, that's what we've discussed this time already, right? So, but he says here that actually for tariffs, he finds it hard to predict because Trump hasn't taken office, right? Trump has said 10 to 20% tariffs across the board, 60% in China. He said he finds it hard to believe that he'll follow through, but what we can do is just wait and see, because this is very unpredictable, or Trump is very unpredictable. Right, so yeah, Shu Shan said we have strong capital position, and if some tailwinds support us when rate goes up, we can continue on the path of paying more, right? The more we make, the more we can pay our shareholders, right? So it looks like she's quite in line with what Gupta is moving towards, which is returning capital to shareholders, which is great, right? Yeah, so here that's where I get the payout ratio is 50%, right? It's said by Suk Hui, right? Hong Kong market continue to be slow. They're conservative there. Credit, there's no sign of stress. I think all these things is okay. China, they've been de-risking for the past few years. They are reducing real estate exposure there, right? MMA wise, they are interested in the 4 countries we've talked about, like India, Indonesia, China, and Taiwan, right? Because they still have access 3 billion, even if they for this year, even if they do the complete 3 billion buyback, right? Because that one plus the dividends payout is 75%, so they still have about 25%, which I think is $3 billion. Right, so wealth management, yes, this is the key driver this year, right? So flows are diversified. People assume it's a lot of China money, but that's not true, right? Southeast Asia and South Asia are pumping money in as well. Alright, so as they go towards investments, right, DBS actually makes more money, right? So normally the money comes in first as deposits, right? Then they shift to investments. So as they shift to investments, DBS makes more money from the managing these investments, right? So anyway, yeah, so there's this competition on some other banks that have cut their rates, right? Gupta says it's not logical too, because it's lower than the fixed deposit cost, right? So I think he's just saying not sustainable. So yeah, anyway, with that, I think it's a good result. It's probably justified that the price has gone up. That being said, I do think at this point price is expensive. Do note that, of course, if going forward they announce a dividend rise again, then likely the price will spike up. So again, all these are just what I think. Please note, none of it is financial advice, and thank you for listening.